Good afternoon, everybody, and welcome to this edition of our Think Learning series. Today's topic is a fundamental analysis refresher. My name is Carl Capitalization. I'm the market analyst over here at Think Markets Australia, and it is a pleasure to be with you as we brush up on our fundamental analysis skills. Now, today's session is a sequel to a session we did a couple of months ago, an introduction to fundamental analysis, where we introduced the concept and a few really practical tools we can use to help us value companies. We're going to move on with that work today. We'll recap some of those tools and introduce one new one, and we'll do that right after we talk about the Think Markets difference, which is substantial. $8 flat rate trades, your own holder identification number, unlimited phone support, and of course no hidden platform or subscription fees. 4 fantastic reasons why you should make sure your next ASX share trade is with Think Markets. And if you are new to the Think Markets family, join us before June 30. Sign up, get funded, get trading, and your first 5 trades are on us. There are some other T's and C's, as there always is in these sorts of things, so head to the website for further details. The agenda for today is to refresh your memory if you did catch that last session, but if you didn't, don't panic. We're going to go over the basics again, bring you up to speed very quickly, and then use some really practical fundamental analysis tools in 3 case studies for 3 very interesting stocks. A little later on, we'll go to the internet, go to the company statements, pull out the key information, and come up with some really interesting valuation comparisons. We'll kick off with an answer to the question of what is fundamental analysis. So if you've never heard of the concept before, basically what we're trying to do is determine the value of a share to enable a comparison with the current market price. Okay, and we're going to do that by finding the intrinsic value of a company. What is the company worth per share? And we'll consider things like the financial performance of the company, its profits, its net assets, its cash flows, etc., etc. We'll also look at management. Typically, a fundamental analyst will do that. We're not going to do that today. We'll focus on more of the practical side of things, but a fundamental analyst will look at management, their performance, their track record, qualifications, etc. They'll also focus on the industry within which a company operates. Are there any mitigating factors there that could impact financial performance? The economy, the macroeconomy, we're just coming out of a global pandemic, so that's an example of a major macroeconomic shock that could impact a company's financial performance, and it certainly did over the last 12 to 18 months. Political and geopolitical factors, so these are often things that come out of the blue. I'm thinking Treasury Wine Estates very recently had a 176% tariff slapped on their exports to China, and that's something that could not have been predicted in terms of company valuation from simply its past financial performance, or even its management, or even its its industry specific factors like what the weather was like for the current vintage, as an example. As I said, bottom line is to determine the value per share to enable a comparison with the market price, and therefore determine whether we're getting a good deal. But be careful. Markets always look forward. This is a key message here. Markets are always certainly analysing the past, but the smartest minds are making predictions about what that means for the future, and they're using the future valuations for the company and comparing to the current market price to determine whether they're getting a good deal or not. And I've used Goldman Sachs just as an example there, but Morgan Stanley, Macquarie, and so on and so forth. Many of these other big research houses are crunching huge data sets to predict the future. We don't have their resources, their financial backing, and in many cases, probably their expertise as well. So we need to find some practical tools and make some sensible assumptions about the future to make sensible predictions, so we can, in our own little way, compete with them. So what we're going to do is we're going to use company reports and the ASX website to get an idea of trends in performance. And we'll ask ourselves if they can continue. So those big research houses I just mentioned, they will come to an absolute value conclusion for a company. XYZ is worth $3.42. We're going to concede that we can't do that level of analysis, and we're going to find other tools that will allow us to compare one stock to another, to say, not that this stock is worth X, but this stock looks to be better value than this other stock here. So we're using fundamental analysis as a relative value comparison tool rather than an absolute value tool. We're also going to use it as a tool to narrow our field of focus, so to go from literally thousands of stocks on the ASX down to a smaller list, which we can then focus on to save us time and effort. But I think the last one's very important as well, as a precursor or in conjunction with technical analysis. Technical analysis is, in my opinion, an even better tool to go from a large list of stocks to a small list of stocks, which we can then compare using fundamental analysis. So this is really all about how we're going to use our fundamental analysis. Okay, the first fundamental analysis tool we're going to look at today is the price to earnings ratio. And it is typically the most widely used fundamental analysis ratio out there. And there's a good reason why. It's a very simple method we can use to compare relative value of a number of stocks. It's easy to find the information we need to make the calculation, and the calculation itself is also relatively straightforward. The PE ratio tells us what we are paying in terms of price for the earnings of a company. I don't have the equation on screen at the moment. It is coming up in a subsequent slide, but basically it's the price divided by the earnings per share. So let's say we have a fixed price. The larger the earnings, the lower the PE ratio is going to be, and vice versa. The lower the earnings, the higher the PE ratio is going to be, and the lower the price, the lower the PE ratio is going to be for a fixed amount of earnings. So a smaller price divided into a fixed amount of earnings is going to give us a smaller PE ratio. So that's why we say lower is generally better. But as a ratio, there are some potential traps due to the fact that markets look forward, not backwards. So markets are more concerned about what the future PE is for a company, for example, at the end of the current financial year or at the end of the next current financial year, rather than what the historical or trailing PE is for a company. Let me give you an example. Let's say we have a company that has a price currently of $10 a share and an earnings per share of $2. And let's say that's the current financial year, denoted by that zero there. The price to earnings ratio is simply 10 divided by 2, which equals 5. Now, let's say that the earnings per share for next financial year is expected to be only $1. Okay, so next financial year, $1 gives us a PE of 10. Okay, so we might find a stock that looks very cheap. Let's say, last month the stock was at $15. It's come down to $10, and with a PE of 5, we now think it's really, really cheap. And we buy it, and the stock continues to fall. Well, we've made the mistake here of not looking to future earnings, which is what the market is doing, and realising that the PE is not really 5, it's more like 10. Okay, and that's just a very simple example to demonstrate, number one, that we can't simply look at a PE ratio value and say it's cheap or expensive just on the basis of what the number is. And number two, we need to obviously, where we can, forecast some earnings per share data into the future. The final bullet point here says that the PE ratio represents our payback period in years, which is quite sensible. It would take us 5 years of stable earnings, and that's a big if there. If we had stable earnings of $2 per share, it would take us 5 years to pay back our investment price. Okay, and on the right of screen, we've got a really interesting little chart here. It's more just for interest rather than something we're going to use, but it does demonstrate the 12-month trailing earnings. So this is on a historical basis each time for ASX listed stocks. And we can see that the average trailing PE is about 16 over the sample, which is over 80 years, so a very large chunk of data here. And we find that when the PE rises, look really above 20, it doesn't spend a lot of time there, but certainly doesn't spend a lot of time above 25. Okay, and that typically occurs because prices have risen at a much faster rate than earnings. Okay, so we get from, say, 16 times last year's earnings, all of a sudden prices are now 30 times last year's earnings, and then we can see typically when that occurs, the PE ratios adjust quite savagely back to the downside. And more often than not, the reason for that is prices have come down very quickly, as future earnings expectations have been adjusted down very sharply. Conversely, we can see that PE ratios really less than 10 are quite rare, and certainly in the low single digits are very, very rare. And once again, we tend to find that prices have been, in this case, sold off very, very sharply. And therefore, we're trading at very low multiples of last year earnings. We do find that then prices tend to bounce back after that and then bring that PE average back in that middle area around the mid-teens. So interesting to consider a PE ratio from a whole of market perspective. What we'll do now is give you a bit of a guide here on PE ratios on a stock specific level. And this ties in what we discussed earlier about the growth in earnings going forward. What we've alluded to so far is that we need to be sensible with the way we use price to earnings ratios. We can't compare stocks simply on the basis of their absolute PEs. We need to take into account the rate at which the E part of the equation is growing. And stocks with rapidly growing earnings aren't necessarily as expensive as you might think from a PE perspective, because that PE is going to shrink over time for a fixed price as those earnings grow. Similarly, we discussed this idea that stocks with very low PEs aren't necessarily cheap if their earnings are expected to shrink or not grow as at rapid a rate as some other stocks. The table on screen gives you an idea on what multiple is a bargain, great value, good value, fair value, and fully valued, depending on the growth in earnings for a particular stock. Now, this is just a guide. This is not a hard and fast rule. It's based upon my experience in the markets and historically my experience on how stocks have performed based upon their PEs and their growth rates. So let's start in the left-hand column, and we're looking for what I classify as low growth stocks. These are stocks who are growing earnings somewhere between 0 and 10% per annum. Now, clearly we haven't included stocks here with shrinking earnings because I would suggest we're probably less likely to be considering them as an investment case anyway. Okay, so stocks with low growth, 0 to 10%, I consider that if the PE is 8, okay, we're getting a bargain. The PE is 10, we're getting great value. If the PE is 12, we're getting good value. If the PE is 15, and remember what we talked about with the whole of market PE over the last 80 years, that's about fair value. You're starting to get an understanding of why I've picked some of these numbers. And I'm thinking that once we get up to 20, we're starting to be fully valued on the company. Okay. This changes as we go up the growth spectrum. Okay. As earnings are expected to grow faster for a fixed price that we pay on a stock today, the PE is going to shrink at a more rapid rate over time to over time come back to what is going to be better value for us. So I think you can afford to pay a slightly higher PE for stocks which have higher growth rates. That's what this is all about. And if the company you're considering has a growth rate of somewhere between 10 and 15%, then I'm starting to think 15 is actually great value. 10 is a bargain. 20's good value. 25's fairly valued, but we're starting to become fully valued over 30. And look, I'll let you press pause and consider the next couple of columns, but I will mention the final column here, which is a stock potentially that is growing its earnings at a very, very rapid rate. Think about it. A stock that can double its earnings from this year to next year will halve its PE for a fixed price over that period of time. In that case, if we were to pay 50 for a stock today, its 1 year out PE is really more like 25. And then you're thinking about, well, where does that take me across this spectrum here? Okay. If I can get it at 40, then its PE, if it can continue its growth into the future, is more like 20. Okay. And don't forget that if a PE is less than 10, sometimes we call this the earnings trap when it comes to PEs. Sometimes it's because the earnings are expected to shrink, not grow. So you do need to be able to forecast earnings growth into the future. And we'll use some practical tools to help you do that as we go along. Okay, that's the calculation for earnings per share, which is on the bottom of our equation for price to earnings ratio. I won't spend too much time on these equations here because we're actually going to do this in a practical sense a little later on. The next fundamental analysis tool we're going to discuss is the price to earnings growth ratio. This one considers how those earnings are growing or shrinking over time. Don't forget, the market loves earnings growth. It effectively makes stocks cheaper as we go. Lower is better for the PE growth ratio, and typically less than 1 is excellent, but we don't want a negative because that, of course, would indicate that we have not growing earnings but shrinking earnings. The calculation, once again, is very simple. We simply take the price to earnings ratio we've just learned how to calculate and divide that by the EPS growth rate. And the EPS growth rate is, there's a number of ways you can do it, a number of metrics you could use to determine the growth rate. I would suggest to you the most common method of doing it is earnings per share. Another way to do it is net profit after tax. This is my preferred way to do it because earnings per share can be impacted by the fact that the S may change. We might have had a capital raising where more shares were issued over time. Assuming a company doesn't make a habit of that, it will impact one period's earnings per share comparison to the next. Net profit is probably a better measure there because it takes that per share element out of it. And therefore, we're just looking in growth in net profit after tax from one period to the last. And it will literally be a number like 20%. And we feed that number in literally as we write it there into the bottom of this equation. And therefore, it starts to make sense that if you had a PE of 20 and you had a growth rate of 25%, then this number here is going to be less than 1, which is what we're after. So any company that has a growth rate greater than its PE will have what we typically classify as an attractive PEG ratio. Okay, next tool, and I intend to move quite quickly through here because we want to get to the case studies. The enterprise value to revenue. Now, this valuation metric is useful for companies that don't have a net profit yet. And if they don't have a net profit, they don't have an EPS. I think that's kind of the message in brackets here. So if you don't have an EPS, you can't calculate your price to earnings ratio, and therefore you can't calculate your PEG. So what about companies that aren't making money yet, but do have substantial revenues? Okay, so revenues exist, revenues are growing, they're just not net profit positive at this stage. And one of the stocks in our case studies today is the perfect example of that. You're probably guessing what it is. Another benefit of using enterprise value to revenue is that it doesn't just look at the profit and loss statement, it looks at the balance sheet as well, because we're taking into account items like debt and cash which exist on the balance sheet. Debt, if you aren't sure, is classified typically in financial statements as borrowings and lease liabilities, and cash is often classified as cash and cash equivalents. Fairly easy to find in financial statements. Lower is better, because we want the enterprise value, which is effectively the value of the business, to be as small as possible for a fixed amount of revenue. Or another way to put it is we want revenue to be as big as possible for a certain value of the business. So how would I write this? A bigger revenue is good, or a smaller enterprise value is good, and both of those are going to result in a lower enterprise value to revenue, which is what we're typically looking for. And to get, again, we need these sort of this spectrum. We've talked about the PE range spectrum over a range of growth. We've talked about the PE spectrum historically for the whole market, and we do that because we need some basis to which we can compare a particular data point. So for the All Ordinaries, now this is the top 500 companies on the ASX, and I specifically didn't do the whole of ASX here because a lot of those companies don't make money. So we've stuck with the biggest 500. The median FY21 enterprise value to revenue number, so we obviously haven't finished FY21 yet, so these are forecast numbers, is 3.5 times. Okay, so the enterprise, the respective enterprise values of the top 500 companies are trading at about 3.5 times their respective revenues. The average is about 6.2. Okay, and I won't go into a big analysis of statistics here, but let's just say that somewhere in between this area is to be considered fairly standard amongst the Aussie market. So let's say this is 0 here, and this is infinity over here. The lower we get from that standard range to 0, that is better or more attractive. And the higher we get above 6.2, that is less attractive, let's say. Okay, I'm not going to say necessarily worse, but it's certainly less attractive. That's enterprise value. That's how to use it. This is how you calculate it. We take the market capitalization. That's what MC stands for. We add to it the debt of the company, and we take from that cash and cash equivalents. Now, both of these are found on the balance sheet. They're very easy to find. And then we divide into that enterprise value the revenue of the company. So a company with greater debt is going to have a greater enterprise value. Remember, that's less attractive for us for a fixed amount of revenue. So it will have a higher enterprise value to revenue. A company with lots of cash compared to its debt will have a lower enterprise value because we're taking it away here, and therefore for a fixed amount of revenue will have a lower enterprise value to revenue, which is attractive. Now, no doubt you're already using the slider on the video player there and replaying of that about 10 times. Do so, it'll help you understand it. Let's keep moving on to the final fundamental analysis tool we're going to discuss today, which is return on equity. And this is a new one. We didn't cover this one last time. It's also known as the return on net assets because shareholders' equity is net assets, which is total assets minus total liabilities. Again, pretty easy to find in a set of financial statements. It is an efficiency or productivity measure. For me, it tells me how good, bad or lazy management is. It talks about management's ability to extract financial performance out of net assets. Okay. Watch, however, when debt levels are very high relative to assets. So a company can juice this ROE by having very, very high levels of debt. So shareholders' equity becomes very, very small. And then for a fixed amount of net profit after tax, this ROE then blows out. So look, it's not the be all and end all, and none of these are. It's something we use in conjunction with our other tools to give us a broader picture of whether a particular company is a good value or otherwise. Okay, so again, we need some goalposts here, a spectrum of value, as it were, for return on equity. And what I've done here is I've gone and looked at the various sectors. Now, different sectors have different average returns on equity. Some sectors have companies which typically utilise a lot of capital. So very capital intensive processes. I'm thinking mining here is a very capital intensive process. Manufacturing is often very capital intensive. So they may have typically lower rates of return on equity. Other companies, I'm thinking software companies here, have a very low capital intensity. But effectively, it doesn't cost you any more to produce another piece of software than it costs you to produce the last piece of software. Those types of business tend to have higher returns on equity. But anyway, depending on what company you're looking at, you can go here and see what the average return on equity is. And I've just used EBITDA positive stocks within the sector. Again, focusing on the better stocks rather than stocks that are not profitable. And we can see that consumer discretionary typically has the highest return on equity, with 15.5%, and then all the way down to utilities and telecommunications, which it makes sense. These are highly capital intensive industries. The average for the All Ords is 12.1%, and that is, for me, the key number on screen. That is typically what I like to compare my ROE to. Look, if we're below 12%, give or take, that is less attractive. And similarly, if we're above 12%, that's becoming more attractive. Okay, where do we find this information from? Well, these are the key documents we need to be able to locate for each company that we're going to do our fundamental analysis on. The Appendix 4Es, which is the company's full year reports, the Appendix 4Ds, which are the half year reports, and in some cases, even the Appendix 4Cs, which are quarterly cash flow reports. For the bigger companies, though, these are the two you're going to use. The smaller the company is, the more important those quarterly reports become. Into the first of our 3 case studies today. And the first one is Fortescue. And I've tried to pick 3 companies that are quite different and represent different fundamental analysis concepts here. I've classified Fortescue as the cash cow. We know Fortescue is doing very, very well at the moment on the back of some really strong iron ore prices that have juiced up earnings over the last 12 to 18 months. Lots of numbers on screen. Let's switch screens now and find out how we can fill in each of those data points. Okay, here we are at the ASX website, our first point of call. It's very easy to find any company we're looking at by simply clicking on the search button there, and you can start to type in the name or the ticker code. Straight away we're hit with some data up top. Its current price, that's obviously moving around all the time while the market's open, how much volume is traded today, its price range, and then one of the items we'll actually be using today, one of the data points we need to fill in, which is market capitalization. And currently Fortescue's market cap is just shy of $70 billion. If we scroll down, we can see a price chart and some volume. There's also a range of data here. Now, we won't be using any of these data points in today's analysis because I have found in the past some of them aren't as reliable as they should be. Now, your experience might be different. I'm going to show you how to get the data we can rely on. Scrolling down further, we can see some interesting little charts here on how the company has performed with respect to its revenue and its net profit. The trend is your friend there. We'd like to see both of those lines improving, and also how it's performing with respect to its dividends. A little bit further down again, and we get the FMG announcements. You'll get the top 5, but we would like to see all announcements, so we'll click on that button there, and it takes us to this page here where we can see all of the ASX announcements for Fortescue. Don't forget, we're looking for some very specific things here. Things like March quarterly production reports, things like half-yearly reports, which as we scroll down we can see them here, and then full year reports. You'll note in this particular case study we don't see the 4D, 4E, 4C that we're looking for, unfortunately. It's just not the way Fortescue do things. But if you see words to the effect of half-yearly report and accounts, that's usually a pretty good sign that we're going to get one of those reports, in this case obviously the half-yearly version, which is the Appendix 4D, and that's where we'll be doing our analysis today. So the process is to continue down this list, pick out those key financial statements, and then we're going to do some analysis on those. So we'll switch screens again and commence our search for the key data points we need to calculate our fundamental analysis ratios. Your best friend in this process is going to be the Control F function, because that will allow you to search for the data you need. Now we're going to kick off, just looking at my notes here, with the price to earnings ratio. And the price we have, that was on the front page there on the ASX website, and we're looking for the earnings per share. So let's try that. Let's try typing in earnings per share. Fortunately, we've come to the right place straight away. You could try typing in EPS. Each company will have their own way of representing or naming this data. Straight away, we can see that we've got some AUD data here and some USD data, so US dollars. Note that almost exclusively Fortescue's data is in US dollars, and I picked this one deliberately to illustrate that sometimes that's going to occur, and you may need to do some conversions back to Australian dollars to get the right data, because let's face it, the price on the ASX is in Australian dollars. You have to be able to make like-for-like comparisons. So in the first half, that is in the 6 months to December 31, 2020, Fortescue earned $1.83.7 per share. Now, this is for 6 months. We need to extrapolate that out to the full 12 months for FY21. We could simply double that. That would assume that Fortescue earns the same amount in its second half as it does in its first half. Now, often companies earn different amounts depending on which half it is. Sometimes earnings are skewed towards a particular half. There's a very quick and easy way to check that, and that is to have a look at the amount it earned in the previous corresponding first half, and then go to the Appendix 4E, which I'm assuming you have sourced, which is the full year report for the year ending 30th of June 2020, and work out, if we go Control F again and type in earnings per share, we can see that for the full year 2020, we earned $2.29 in AUD. So for the first half of 2020, we earned $1.16, and in full year, we earned $2.29. It's simple maths now to work out what we earned in the second half of FY 2020. Trusty pocket calculator here, 229.2 minus 116.4, and that tells us that Fortescue earned 112 cents or $1.12 5.8 in the second half of FY20. So they were pretty similar. You wouldn't say on that basis that earnings are skewed towards one half or the other. For Fortescue, the other thing to note there is that earnings actually shrunk from the first half to the second half in FY20. So it does start to give us an idea of potentially the growth in the company or lack thereof in this case. The takeaway here is, how do we extrapolate the current financial year's first half earnings per share into a full year earnings per share? Straight away on that basis, I think we're pretty safe to double it, okay? Give or take, 183 is going to become 367 or so. What I like to do is go a little bit further and try and understand the growth in the business from the current half compared to the previous half. So to find a sensible growth rate to extrapolate out these first half earnings to full year earnings, we are going to find the net profit after tax. You recall earlier in the presentation, we talked about not using EPS to extrapolate out earnings because the S part of the equation, the shares part of the equation, could change. We said we were going to use net profit after tax, which fortunately is on screen already. We didn't have to look too far, and we can see that that is 4084, and that is in US dollars. So we do need to convert that, and I'm going to use an exchange rate of 75 cents. That gives us 5.4, and we're talking billions here for the first half. We're going to store that in the memory banks and then figure out how much Fortescue earned in net profit for the second half, and then make that half-on-half comparison between the second half and the current half. So 2453, heading back to the full year, we've got 4735. So if we go 4735 minus 2453, we get a net profit after tax for the second half of FY20 of 2282. We can then divide that by 0.75 to put it into Australian dollars, and we can get a growth rate from the current half, which, if you remember, was about $5.4 billion, by simply dividing that into the memory recall, hitting enter, and taking the inverse of that, which is 78% growth in net profit after tax. Now, that obviously is a very large growth number. Do we then extrapolate this half's net profit after tax by 78% to calculate the potential full year earnings or earnings per share? Look, I'm not going to do that. I'm going to try and take a bit more of a pragmatic and common sense approach. And again, this is all about illustrating how you can do fundamental analysis and make it forward looking rather than just relying on Yahoo Finance historical numbers. Let's have a look at what the iron ore price did from June 30 to the end of the first half FY21 reporting period, which is over here at December 31. So we can see the price went from about $99 US per tonne to up to about 100, and I'm going to say 64 per tonne. So if we say 164 divided by 99 minus 1, that's a 66% growth in the iron ore price over a period where Fortescue demonstrated a 78% increase in its net profit after tax. So clearly the two are very, very closely tied together. The question then becomes, well, what sort of growth rate have we seen? Let's look into the future. What sort of growth rate have we seen from that December 31 into the current time? We've gone from around about 164 into the current price around about 190. And this growth in the iron ore price is what's going to be potentially energising Fortescue's second half results. So if we go 190 divided by 164 minus 1, that gives us a growth rate of about 16%. Okay, and I think that's a more realistic growth rate to then extrapolate out Fortescue's second half earnings. So if we go 183.7, which was the first half earnings, that's in the bag. Nothing's going to change that. Times it by 1.16, which is grossing it up by 16%, we get $2.13. Add that back to the 183.7, and we get a potential full year earnings per share for Fortescue of about $3.96 a share. Okay, and that's what we're going to use in our PE ratio calculation. Okay, so let's review some of the data we've got so far. We've got the market price, the market capitalization. We've got an estimate for full year 21 earnings per share. And we've got a sensible earnings per share growth rate as well. There's a couple of other bits of information we need to get. I'm thinking primarily for our calculation of enterprise value to revenue, and one of those would be debt. So if we search for debt, that's probably a fairly broad thing. If you remember, we talked about debt being borrowings and lease liabilities, and lo and behold, there we are. Straight away, we get a total debt number of 4.1 billion, let's call it. And we've also got our cash and cash equivalent number of 3.9 billion. So those two numbers get plugged directly into our enterprise value to revenue calculation. Let's find revenue now, because we need that number as well. And once again, it's as simple as typing in what we're looking for, and that revenue there is 9,335. Now we need to remember two things here. Number one, 9,335 is in US dollars, so let's convert it to Australian dollars. That's for the first half. That's in the bag. Let's stick that in our memory bank, gross it up by our 16% growth rate, and then add it to our memory bank, and that's going to give us a total estimate of revenue for Fortescue for full year 21 of about 26.8, let's call it, $billion. Okay, we're nearly there for Fortescue. We just need to work out our return on equity. And for that, we typically would use net profit after tax divided by average total equity from this period to the last. Let's kick off with finding total equity, because that's quite easy to find. It generally is a specific line in the balance sheet. And we can see we've got around about $15 billion for the current period, and then about 13 for the previous period. Obviously, we'll convert those back to Australian dollars in our final calculations to work out the average total equity. For net profit after tax, I'm going to go Control Home, and then it's not hard to find this one. We have the 4.084 billion number. Now, we can use the same process as before. We would take this number, obviously convert it to Australian dollars, which gives us about $5.4 billion. Store that in our memory banks, gross it up by 16%, which is the growth rate we're using for Fortescue in this case study. Add them together, press memory recall, and we're going to get about $11.7 billion projected worth of net profit after tax for full year 21. I'm going to do something a little bit different today, simply because of the next case study stock doesn't have net profits just at this stage, but they do have earnings before interest, tax, depreciation and amortization, otherwise known as EBITDA. So to keep the comparisons like for like, we won't use that number. We're going to use the EBITDA number instead. Okay, but typically that's the number you would plug into your return on equity calculation. So to find EBITDA, we will search for it here, and it should come up fairly quickly. There we go, underlying EBITDA of 6639, and you would use the same process we just used to project this into a full year number. So 6639 divided by 0.75. We're going to store that in our memory banks, gross it up by 16%, add it, and then recall it, and we'll get a forecast EBITDA number for Fortescue for FY21 of $19.1 billion. We now have all the data we need, so let's head back to the slides and conduct our Fortescue valuation calculations. Okay, and just like magic, all the numbers have been filled in. We're working off a current price of $23.10 for Fortescue. Of course, that could be changing as we speak. We did estimate that full year earnings per share would be $3.96. And when we do the calculation, we get a price earnings ratio of 5.8. We plug that into our PEG calculation with a growth rate based upon Fortescue's earnings per share from this half to the last half. So first half FY21 to last half FY20. And we get 78% on that, which gives us a PEG of 0.07, which is extraordinarily low. However, I'm going to cross that out because of the analysis we did on the iron ore price. That 78% increase in earnings per share from H2 20 to H1 21 was on the back of a 66% increase in the iron ore price. We've had more like a 16% increase in the iron ore price since December 31, 2020. So let's use 16% as our growth rate, and therefore the PEG rises to 0.36, which, if we use our rule of thumb of wanting that to be less than 1, is still very, very good. Enterprise value to revenue, the current market cap for Fortescue is about $70 billion. We worked out how much debt was on the balance sheet as well as cash. We also worked out how much revenue it was likely to have for full year 2021. And when we do that calculation, we get 2.6 for enterprise value to revenue, which, remember, is well below the sort of market standard range of 3.5 to sort of 6. Return on equity, we are going to use EBITDA here instead of the typical net profit after tax, simply so we can compare it to the next case study. That came in at 19.1 billion. The average total equity is calculated by summing this period's equity and last period's equity, dividing by 2, and the return on equity in terms of EBITDA, that is, comes out at 101%. Now, if we use the standard, which is net profit after tax, that return on equity comes down to 62.5%, which is still extraordinary when you compare it back to the market average of about 12%. Okay, keep all those numbers in mind as we head to Afterpay, which I've labelled the conundrum. And that is because whilst it has spectacular growth year on year, the company is yet to earn a profit. So how do we compare a company that does make profits to one that doesn't make profits? Well, first of all, we can't use the PE ratio because with negative earnings, that calculation isn't going to make any sense, nor will the PEG calculation. This 30.5% growth rate, I'll explain how I achieve that when we head to the company statements, as we will do for the rest of those numbers. Let's head there now. Okay, first up, the ASX website for Afterpay. This is where we can get the market capitalization. Let's call that 31 billion. And we can scroll down and see the trend in revenue growth, and also see that we're not quite having a net profit just yet. We also get the ASX announcements, where we can then locate all of the financial statements. And we are searching for data for our enterprise value to revenue number. So let's kick off with borrowings, because that will come into the top line along with market capitalization. And we can see that we have borrowings of 122 million, along with cash of 460.5 million. The bottom line of that calculation is the revenue number. So let's search for revenue. And we can see that the revenue for Afterpay for the first half was $417.2 million. Now, we need to extrapolate that out to project a full year number. And to do that, we need a growth rate. To get the growth rate, we need net profit after tax. And remember, from that ASX little image we saw, Afterpay isn't yet showing a net profit after tax. So we're going to use earnings before interest, tax, depreciation and amortization, EBITDA, as a proxy for our NPAT, just simply to allow us to make comparisons to Fortescue and the next case study stock. So let's search that up right now, EBITDA, and we can see that EBITDA for the half year ended 31st December was 47.9 million. I'm just going to skip down a little bit until we get to a comparison to the previous half, and that was considerably lower, 7.7 million. That is for the first half of the previous financial year. We need to determine what the EBITDA was for the second half. To do that, we're going to search for EBITDA in the full year report, and that will show 44.4 million. We get our trusty pocket calculator out, 44.4 minus 7.7, just confirming there, 09, and we get 36.69 as EBITDA for the second half. Now we can get an idea of our growth rate. We've gone from 36.69 in the final half of the previous financial year to 47.89 in the first half of this financial year. To get the growth rate, we simply divide that by 47. We'll make it 0.869 here to keep it like for like. Inverse it, -1, and that gives us a growth rate for Afterpay of 30.46. Let's round it up, call it 30.5%. We can use that now to extrapolate out our revenue to a full year number. So 417,205. Let's whack that in the memory before we hit enter. And we're forecasting a second half EBITDA of 544,307. We'll add that and then display the result. And that gives us 961,512,000 for the full year revenue. That goes straight into our enterprise value to revenue number. Let's do our return on equity now. For that, we would typically require net profit after tax. We're not going to do that. We're going to use EBITDA. We've got our growth rate, so we could that's quite easy to work out now because we know that the current EBITDA is 47,869. I'm going to store that, times it by our growth rate, which is 1,305. Hit enter, add that, memory recall, and it gives us a forecast, a projected full year EBITDA of $110.3 million. On the bottom line of our return on equity calculation, we need our average total equity, and we get that by typing in total equity into the search bar, and we've got 1.7 billion for this period compared to 946 million for the second period, and that's all the data we need. So let's head back to the slides and plug in the numbers. Market capitalization, the debt was 122 million, cash was 460 million. We projected into $961 million worth of revenue to give us an enterprise value to revenue of 31.9. We projected 110 million in EBITDA for the full year, and we got our total equity numbers to get our average, and it gives us a return on equity, assuming EBITDA of 8.3%. Now, I will note here, whilst we couldn't come up with an estimate for earnings per share for FY21, the brokers are predicting an earnings per share for FY22 of about 46 cents. Now, that is an average of about 6 different brokers and their expectations for FY22. If we use that in our PE ratio, the FY22 PE works out to be about 108. Now again, cast your minds back to the average market PE of around about sort of 15 or so, and it gives you an idea of where we are with Afterpay. And really, this P here, this P part of the equation, is massively dependent on this growth here. And I would suggest that our 30.5% growth, whilst for me it makes perfect sense, is below what many of the big research houses are estimating. And, you know, again, beauty is in the eye of the beholder. And the key message here is that you have to make your assumptions based upon what you can see. There's no right or wrong answer. They are your assumptions, and they will then skew your idea of what value is on any particular stock. Let's move on to the final stock today. It's Kogan, ticker code KGN. And I'm poking a little bit of fun there because the stock has fallen very sharply from its highs. And I get many questions from clients asking me, look, is Kogan a bargain yet? So this analysis hopefully will answer that question for you. Lots of numbers on screen. Let's head over to the ASX website and start collecting the data. Okay, straight up, our market capitalization. We need that for our enterprise value to revenue number. Scrolling down, we get an idea of Kogan's growth in revenue and also net profit after tax. We can see there is a net profit after tax there, so we can do quite a bit more analysis on this one than we could for Afterpay. Scroll down again, we get to the announcements from which we can find out financial statements, which we'll head to now. Okay, first up, let's find our earnings growth rate, and to do that, we'll focus on our net profit after tax, which for the half year ended 31st December is 23.592 million, and we can see that the corresponding value from the first half of the previous financial year is 8.92 million. Of course, we need to do some maths and figure out what the net profit was for the most recent half, which is the one in between these two, and then compare that back to the current half to get our growth rate. Let's head to the full year numbers for that, and we can see that the full year profit was 26.82. So out comes the trusty pocket calculator, and from that we're going to subtract the previous half number of 8929, and that tells us that for the second half of FY20, Kogan earned a net profit of $17.89 million, and that compares favourably, or at least the current result of 23.592 compares favourably to that. Let's find our growth rate by dividing by 23.592. We'll take the inverse of that and minus 1, and that tells us that our growth rate is 31.8%. Now, when we get to the slides, you're going to see I'm using a slightly lower number again, and that's because I'm adjusting for some of the issues that were identified in the quarterly report. I won't go into that report now because we're very, very short on time, but suffice it to say, I've adjusted the expected growth rate a little bit lower. And now that we have a growth rate, we can project a full year earnings per share number to using our PE ratio calculation. For that, I'm going to search for earnings, and we can see that Kogan earned 22 cents per share for the first half of FY21. Trusty calculator comes back 0.22 times our growth rate, which we said I had adjusted to 25%. Hit enter, add the 0.22 from the first half. We get a full year estimate for earnings per share of about 49.5 cents. Let's keep gathering the data and move on now to our enterprise value to revenue calculation. For that, obviously, we need market capitalization on the top line. We've got that from the ASX website, but we also need borrowings and the current cash balance. So let's start off with borrowings, and straight away we've come up to the consolidated statement of financial position. And we can see loans and borrowings are split here into current and non-current liabilities. So out comes the trustee calculator, and we'll start with the current liabilities, loans and borrowings, which is 1472. Add to that the lease liabilities, which is 2780. Non-current items, now lease liabilities 7995, and then non-current loans and borrowings 1236, and it gives us a total of about $13.5 million worth of borrowings. Let's find the cash. Cash and cash equivalents at the moment about 78.9 million, and that's the top line of our enterprise value to revenue number. Let's head back to the start and find revenues from ordinary activities, which is 414,000. Trusty calculator comes back out. Let's put that number in the system, 009. Save that, but then times it by our growth rate, which is 1.25, hit memory plus and recall it, and it gives us a projected revenue for FY21 of about $931.5 million for Kogan. The final ratio we need to find data for is the return on equity. So let's search for total equity, and up on screen straight away, it's this line here. Current period, 199.3 million. Previous period, 164.025 million. That's the bottom line of the equation taken care of. The top line is the typically we'd use net profit after tax. This time we're going to use EBITDA so we can compare with Afterpay. And we can see here we've got an EBITDA of 38.8 million. We can gross that up for the full year by going 38.8. We'll store that in our memory, times it by 1.25, which is our growth rate. Add that and recall it, and we get $87.3 million for our full year forecast revenue number. That's all the data we need. Let's head back to the slides and complete the calculations. Okay, we'll kick off with the price to earnings ratio, for which we need the current price. It was 10.60 when I took the snapshot earlier on today. We forecast a full year 21 earnings per share of 49.5 cents based upon the growth rate we calculated and an adjustment for what's occurred in the first quarter result. For brevity, that's a judgment call that I made. It gives us a price to earnings ratio of 21.4, certainly compares better than the 108 for Afterpay, that is on an FY22 basis, but not as good as the Fortescue, which was 5.8. Plug that 21.4 into our PEG calculation, and we end up with a PEG of 0.85, which is better than that sort of rule of thumb 1, so pretty happy with that. In terms of enterprise value to revenue, we've got the market capitalization, adding the debt of 13.5 million, subtracting the cash balance of 79, divide into that our forecast FY21 revenue of 931 million, and you get an EV to R of 1.2, which is very, very attractive compared to that sort of 3.5 to 6 range for the market that we observed earlier on. In terms of return on equity, again, this is EBITDA, not NPAT, but we forecast that EBITDA to be 87.3 million for the full year, and we worked out our total equity numbers here for the current and the last period. If you calculate that, you will get a number of 48%, which is more attractive, again, than Afterpay, but not as attractive as Fortescue. And if you do wish to go check it for yourself, if you plug in the net profit after tax into that number, like we're supposed to, we get a return on equity of 29.2%, which is outstanding compared to the market return on equity of just 12.1%. Let's put all of our calculated data into a table. It makes it easier to make the comparisons. And we can see that in terms of the price to earnings ratio, Fortescue appears to come out ahead, but do note it has the lowest forecast growth rate out of the three stocks. Afterpay has the highest growth rate. The PEG of 0.36 appears to be quite attractive for Fortescue, assuming that that 16% growth rate is going to be maintained. Some of the brokers are expecting it that it would be less than 16% going forward because they expect that the iron ore price will come back a bit. Again, whether we're Goldman Sachs or a mum and dad investor, we have to make assumptions about the future. And we've explained how we've made ours here today. For Kogan, the PEG is still less than 1. That's very good at 0.85. In terms of enterprise value to revenue, we have a new leader here, and that is Kogan with 1.2. Fortescue still very well placed at 2.6, and Afterpay, you would say that is very high at 31.9. In terms of return on equity, and remember this is based upon EBITDA, not NPAT, Fortescue comes out in the lead. Next is Kogan, and once again, a long way behind is Afterpay. Looking at that table, you would say that Afterpay looks very, very fully valued indeed based upon those numbers. Fortescue's looking pretty cheap. Kogan's looking pretty cheap also. To put it into perspective, let's look back to our PE ratio table and place our 3 case study stocks. I've put Fortescue here because it is probably going to be a low growth stock over the next year or two as iron ore prices normalise. There's still a pretty good chance we can see positive growth, but it's not going to be the 78% that we've seen in the recent past. It's just too unlikely that iron ore prices are going to continue to rise like that. Hey, anything's possible, I guess. So, based upon its PE of 5.8, that still puts Fortescue in the bargain basket. Kogan, I've placed as a high growth stock. We're using a 25% growth rate on that, so that puts that into the 15 to 30% range. With a PE of around about 21.8, it places it at great value according to this scale. And Afterpay, with an FY22 PE of 108, and with a growth rate probably somewhere between 30 and 50%, but let's give it a little bit of leeway there and say it's a quote-unquote ultra-high growth stock. Certainly that's the way the market's looking at it. Still though, with a P of 108, you would have to say it is closer to fully valued than looking like a great deal at this point in time. And hey, recent share price moves are probably reflecting that. Having said all of these things today in the presentation that is nudging 1 hour long now, I must remind you that fundamental analysis is a tool that can be used with other tools like technical analysis, and I would look for a confirmation signal from the technicals before acting upon any of the fundamentals, and more specifically, positive price action, positive candles, to confirm that if we have found something we think is very cheap, that the market is starting to believe it's cheap as well. And I think it's when you get the marriage of two that you really do get something special with your analysis. Well, that brings us to the end of today's presentation. Thanks for sticking with me for the whole time. And there was some pretty heavy content there. So use that slider to go back and review any of the bits you think you need further clarification on. You can catch all of our other analysis in the market news section of the website. If you'd like, you can follow me or the Think Market handles there on Twitter. We do have some other webinars that you can register for. Next week on Wednesday, 11th of April, we'll have Ask the Experts, where you get to bring your portfolio to the table. Make sure you register in the webinars section of the website. That's the link there. And I'll give you a quick technical and fundamental on the stocks you're interested in. A week after that, we'll continue our top 3 series, this time with the top ASX stocks under 30 cents. That'll be exciting. And then we'll continue our Think Learning series with a technical analysis edition, this time how to use price action to spot trading signals. The disclaimer before I leave you today says that everything we've discussed is general in nature. We are a regulated broker and we do have some products that could see you lose more than your deposit. So before you act upon any of the information in this presentation, please read this disclaimer carefully or give us a call. It has been a pleasure chatting with you today. Hopefully you learned lots. All the best for your trading until we catch up again. Bye-bye for now.